the US Federal Reserve. Even the name sounds powerful, and it is. When the Fed speaks, the world listens. This American institution doesn't just steer the US economy, it sets the tone for global financial markets. Think of the Fed as the conductor of a massive orchestra. Each instrument represents a different part of the world economy. The Fed's interest rate decisions are like the tempo the conductor sets. The Fed's decisions send ripples across the globe, impacting everything from borrowing costs to investment returns. To understand the Fed's impact, you need to grasp its primary functions. The Fed is like a central bank's central bank. It controls the US money supply and influences interest rates. Think of it as the guardian of price stability and economic growth. It's a tough job, requiring a careful balancing act. The Fed uses various tools to achieve its goals. One key tool is setting the federal funds rate. This is the interest rate banks charge each other for overnight loans. By adjusting this rate, the Fed influences borrowing costs across the economy. Another important tool is open market operations. This involves buying or selling US Treasury securities to influence the amount of money circulating in the economy. When the Fed buys securities, it injects money into the system, potentially lowering rates. When it sells, it pulls money out, potentially raising rates. The Fed's decisions on these tools can make or break market sentiment. All eyes are on the Fed's September meeting. The big question: will they cut rates, keep them steady, or, gasp, raise them again? Predicting the Fed is like predicting the weather. You can look at the signs, but you never know for sure. Current economic indicators paint a mixed picture. Inflation seems to be cooling, but the job market remains strong. This makes the Fed's decision even more challenging. Some analysts believe the Fed will opt for a rate cut to stimulate the economy further and avert a potential recession. Others argue that the Fed might keep rates steady to avoid reigniting inflation. A rate hike seems unlikely at this point, but with the Fed, you never know. Section 4. Nifty 50, riding the rate cut wave. So, how will the Fed's decision impact Indian markets, specifically the Nifty 50? A rate cut by the Fed could be a boon for the Nifty 50. Lower US rates tend to weaken the dollar, making Indian exports more competitive. This is good news for export-oriented sectors like IT and automobiles. Additionally, a rate cut could boost foreign investment in India as investors seek higher returns in emerging markets. Sectors like technology and automobiles, which are sensitive to global demand and financing costs, could outperform. However, a rate cut is not a magic bullet. Other factors, such as domestic economic conditions and global commodity prices, also play a role. Section 5. Bank Nifty. Bracing for impact. While a rate cut might benefit the Nifty 50 broadly, the impact on Bank Nifty could be more nuanced. Lower interest rates can squeeze banks' net interest margins, potentially hurting their profitability. On the flip side, lower rates can also spur credit growth as borrowing becomes cheaper. This can benefit banks in the long run. The outcome for Bank Nifty will depend on which force, squeezed margins or increased credit growth, proves stronger. Investors should closely watch the commentary from the Fed and the RBI for clues about the future direction of interest rates. Section 6. Investors' Playbook. Navigating the Fed's wake. The Fed's September meeting has the potential to shake things up. So, what's an investor to do? First, don't panic. Making impulsive decisions based on short-term market movements is rarely a winning strategy. Instead, focus on the long term and maintain a diversified portfolio. If the Fed cuts rates, sectors like IT and automobiles might present good opportunities. However, be mindful of valuations and don't chase returns blindly. If rates remain steady or rise, Bank Nifty might face headwinds. However, This could also present buying opportunities for investors with a long-term perspective. Remember, the key is to stay informed, stay invested, and ride out the volatility. The Fed's decisions might seem far removed from your portfolio, but their impact is real. By understanding the Fed's moves and their potential consequences, you can navigate the markets with greater confidence and make more informed investment decisions.